The stock market ripped higher last week, rallying 8%. We actually hit the lows Monday afternoon during the trading session. The low was 508 on the SPY, and we ended up at the highs on Friday at 550.64. Friday's trading session was up 0.72%. So it was a really solid week. 8% seems like a lot, but it was almost nothing considering the massive volatility that we've seen throughout the month of April. We're coming into a really important level for the market in general. When we look at the SPY's chart, you can see this very important zone here that's right around 550. We did close above that on Friday, but you can see how many times this 545 to 550 level has acted as support and resistance going back to the middle of March. Zooming out just a little bit further on our chart, you can see the important inflection point that we're coming into in the distribution of gamma exposure data. The purple bars are gamma exposure by strike price, and we've really seen a shift in the gamma exposure data to more of a positive skew. We did close in positive gamma exposure territory, as you can see, defined by our zero gamma level, which is the blue line on our chart. Our dealer cluster zones are sitting very close together, and this is basically indicating that market participants and dealers are all focused on this zone between 540 and 560 on the SPY. This just reinforces the idea that we are coming to an important inflection point in the market. We've been looking for clues to see how the biggest players in the market are positioning themselves. There is still a very wide distribution, basically suggesting that anything can happen. So we continue to be in a very headline-driven market, and I suspect that that's going to be the case and the determining factor as to whether we break up or break down from this very important inflection point that we're currently sitting at. So the big question is, when there's this much uncertainty in the market, how do you play it? We've been structuring our options portfolio with a series of staggered positions, both hedges to the downside using SPY put debit spreads that will protect us if the market does break down. We'll earn profits in this zone, as well as long bias positions using names like Nvidia and Meta to structure out of the money call debit spreads that can potentially see profits if we see a big breakout to the upside. So although we have seen a huge collapse in volatility since the highs back in early April, the VIX is still sitting right around 25. In our view, this is still a level of heightened volatility. We see market participants continuing to concentrate at the 42.5 strike on the VIX in the options market, as well as the 50 strike. Market participants are still concerned for a potential spike in volatility again heading into May, and that's something we're continuing to take very seriously in our portfolio as well by focusing on an asymmetric risk-reward strategy that can potentially capture moves in both directions. And guys, if you're interested in learning more about our portfolio approach and tracking the moves we're making in our own portfolio, head on over to geeksoffinance.com. I'll put a link in the description below. Next, let's take a look at small caps by checking on IWM, trading at 194.12, basically flat on Friday. Despite the strength in the other indices, small caps have really been a dog this year. We're still in a steep downtrend. The gamma exposure data is still skewed heavily to the downside as well. This 190 strike has been a very big focus in the gamma exposure data. We've seen a lot of volume come in the options market around this 190 and 180 zone, and that continues to be the case. If we were just to look at IWM in a vacuum, I would say bears continue to remain in charge and further downside looks likely. However, when we switch over to the Qs, we see a very different picture. We still see a big negative trend over the last couple of months, but the Qs have been performing very well over the month of April. Friday, we were up 1.11%, closing at 472.56. The gamma exposure data has shifted to the positive side. We actually saw the largest gamma exposure concentration sitting at 485, well above where we closed on Friday's trading session. This level also appears to have broken out of the resistance at 470 on the Qs. So a little bit of a stronger move on the Qs than what we're seeing on the S&P, and much stronger than what we're seeing in small caps. Next, I want to take a look at a potential idea in Tesla that we're considering to add to our portfolio. This would be a way to potentially capture market upside if we do see a big breakout in the coming weeks. Tesla Tesla has been consolidating below the 300 level for the past 2 months. We made a big move in the last week or so up to this 300 strike. We've seen gamma exposure shift higher. So the largest gamma exposure concentration is at 300, but we see big spikes at 350 and at 400. This basically tells us that market participants are confident enough to speculate in the options market by going big at these higher strikes. What's also interesting is this zone around 300 is a big resistance level for the last 2 or 3 months. And I think if we can break above this, that's going to provide some natural bullish momentum. In addition to the pressure we're seeing from the options market could really increase momentum to the upside. So we're watching this 300 level for a potential breakout. And one of the ways we're considering adding exposure to this move is by buying the out of the money call debit spread, something like the 325 375 call debit spread expiring May 30th. This is something we're considering adding to our portfolio. This actually fits really well within the context of our asymmetric risk reward strategy. Currently, this particular debit spread is going for somewhere around $6.40, and that would give us a potential max profit of $43.60 if it got all the way to 375 by the end of May. This is also an area which saw previous support and resistance as well. And so I think that makes for a natural next target if we can break above this 300 level. So that's nearly a 9-to-1 reward to risk ratio. And that's the kind of asymmetry we look for, especially when we're putting on more speculative names in the portfolio. We consider the overall structure of the gamma exposure data. We also consider consolidation ranges and price trends and look for potential breakouts where we can see outsized gains. And guys, if you're interested in accessing our gamma exposure dashboard, we are running a special promotion, $300 off our yearly portfolio manager tier subscription. Use code Easter2025 at checkout. We're about to end this promotion, but we do have a few spots remaining. Take advantage of it while you can. Members also get access to the premium channels in our community Discord. You can track all the moves we're making and see what we're doing in our own portfolio, as well as share trade ideas and setups with the other traders in our great community as well. I'll put a link down in the description below. Be sure to check that out when you get a chance. Thanks so much, everybody, for watching, and we'll see you guys in the next video.